Hi everyone and welcome again to Finance Friday. This is a commonly held view but one that's not quite true. In fact, the increases we've seen to investment home loan rates have come as a direct result of two changes actually imposed on the banking sector by their regulator, APRA. This is because APRA wanted to ease the pressure on home prices, predominantly in Sydney and Melbourne, which they in turn believe was inflated by investors as opposed to owner-occupiers. Now, the first of these two changes occurred in mid-2015, and this change saw the amount of growth that any bank in Australia can have in their investment home loan book capped to 10% in any one given year. Now, considering at the time some of the larger banks were growing that particular book by 20% per year, this saw a lot of money disappear from the market in terms of borrowers' availability to access it. The second change came in March of 2017, and this saw the banks also capped, but this time with regard to the amount of interest-only funding that they can have on their home loan book. Now, this cap was 30%. Again, at the time, some of the banks were already in excess of 40%. So this was quite a double whammy for investors and saw even more money disappear from the market. What we've seen by way of a response, and bear in mind this is independent to any changes imposed by the Reserve Bank, is we've seen the banks increasing interest rates on some of their loan products and actually decreasing the interest rates on some of the others. As a result, we have various different interest rates, owner-occupied versus investment, where owner-occupied is by far cheaper than investment loan rates, and also principal and interest versus interest only. Obviously, interest-only loans being far more expensive. So investors who have interest-only home loans for tax purposes have taken a double hit. On the flip side, owner-occupiers who traditionally have principal and interest reducing loans have in many cases seen their interest rates reduce despite not having any official cuts through the Reserve Bank. The level of increase or decrease imposed by any particular bank will largely depend on how close they are to the previously discussed prudential limits. So now more than ever, it pays to shop around, and especially beyond the big four banks. Now at Account Plan, we've got a lender panel that is 15 strong, and so why not let us do the running around for you and find the best outcome for you for your circumstances. So until our next edition of Finance Friday, have a great week.